October 10, the crypto market experienced a dramatic crash that left investors and analysts alike scratching their heads. For months, the reason behind this sudden downturn remained elusive. Many speculated about macroeconomic factors, regulatory news, or even technical glitches, but nothing seemed to fit the timing so precisely. The market's inability to recover or even stage a meaningful bounce only deepened the mystery. Today, however, the answer has become painfully clear, and it all ties back to a structural shift that few saw coming. Let's break down exactly what happened and why the market still can't bounce back. Understand the crash, we first need to look at DATs, companies like MSTR and BMNR. These firms have been one of the two major forces driving the current crypto cycle. Their influence on the market is significant, as their buying activity has helped fuel price rallies and maintain momentum. Without their participation, the market's strength would be severely diminished. Recognizing their role is crucial to understanding why October 10 was such a pivotal day for crypto investors everywhere. DATs operate with a straightforward yet powerful model: grow big, get added to major indices, and trigger passive index funds to buy their stock. This creates a feedback loop. Each time they grow, more funds are forced to buy, which makes them even bigger. It's a cycle that has powered much of the recent growth in the crypto sector. This model has worked seamlessly, allowing these companies to leverage their size and market presence to attract even more investment, further amplifying their impact on the market. October 10, MSCI, the world's second-largest index provider, released a critical update that would shake the foundation of this model. MSCI began questioning whether companies whose core business is holding crypto should be classified as traditional companies or as funds. This distinction is far from trivial. It has massive implications for how these firms are treated by index providers, and by extension, by the entire investment community. These crypto holding companies are labeled as funds rather than companies. They become ineligible for inclusion in passive indices. This is because including them would create a circular feedback loop. They buy Bitcoin, their market cap rises, they get added to indices, which forces more buying, and so on. Such a loop could destabilize the market and undermine the integrity of index-based investing, making this classification a critical issue for all market participants. Let's break down the feedback loop in simple terms. When a company buys Bitcoin, its market cap increases. This growth can lead to its inclusion in major indices, which then forces passive funds to buy even more of its stock. This in turn gives the company more capital to buy additional Bitcoin, repeating the cycle. If unchecked, this loop could artificially inflate prices and create systemic risks for both the crypto and traditional financial market. Market is now anxiously awaiting the official ruling from MSCI, scheduled for January 15, 2026. This decision will determine whether companies like MSTR are classified as funds or companies. The outcome will have a profound impact on their future in major indices and by extension on the broader crypto market. Investors are watching this date closely, knowing that it could trigger significant market movement. If the ruling is negative and these companies are removed from all major indices, the consequences will be immediate and severe. Pension funds, ETFs, and all passive trackers would be forced to dump the stock instantly. This mass selling could trigger a sharp decline in prices, not just for the affected companies but potentially for the entire crypto sector. The threat of forced selling is a major overhang on the market right now. Negative ruling would not only force immediate removal from indices, but also prevent these companies from ever being included again. This would effectively kill one of their biggest growth engines, as passive index inclusion has been a major driver of their expansion. Without this mechanism, their ability to attract new investment and grow would be severely limited, fundamentally altering their business model. October 10, as soon as MSCI's update was published, smart money quickly recognized the structural threat. These sophisticated investors moved ahead of the crowd, repositioning their portfolios to minimize risk. Their early actions contributed to the sharp market drop, as they anticipated the potential fallout from a negative ruling. This is a classic example of how institutional investors can move markets when they spot a major structural change. Timing of the crash on October 10 was no accident. It was the precise moment when the market recognized a structural threat to its strongest buyers. The sudden realization that a key growth engine could be shut down triggered widespread selling and a loss of confidence. This was not about random volatility or external shocks, it was a direct response to a fundamental change in market structure. Since October 10, the market has struggled to recover. The uncertainty surrounding the MSCI ruling has kept investors on edge, preventing any meaningful bounce. With such a significant decision looming, many are hesitant to re-enter the market or take on new risk. This persistent weakness is a direct result of the unresolved structural threat hanging over the crypto sector. Market is likely to remain weak through late December as investors await the official ruling. With so much at stake, few are willing to make big bets until there is more clarity. This period of uncertainty could see continued volatility and low trading volumes, as everyone waits for the next shoe to drop. The outcome of the ruling will determine whether the market can recover or if further declines are ahead. The MSCI ruling is negative, expect a massive sell-off as index removal gets priced in. The forced selling by passive funds could trigger a cascade effect, driving prices down sharply. This scenario would likely lead to a prolonged bear market, with confidence in the sector taking a major hit. Investors need to be prepared for heightened volatility and the possibility of further declines. On the other hand, if the ruling is positive and these companies remain classified as companies, the bull market could resume almost instantly. The removal of uncertainty would restore confidence, and passive funds could continue to buy, fueling another rally. This scenario would see renewed optimism and potentially new highs for the crypto sector as the structural threat is lifted. Passive funds such as ETFs and index trackers play a huge role in today's markets. Their buying and selling decisions are dictated by index inclusion rules, not by active analysis. When a company is added to or removed from an index, these funds must adjust their holdings accordingly. This mechanical buying and selling can have outsized effects on stock prices, especially for companies with large index weights. Being included in a major index is a game changer for any company. It guarantees a steady stream of buying from passive funds, which can help support the stock price and attract additional investment. For crypto holding companies, index inclusion has been a key driver of their growth and market influence. Losing this status would be a major setback, both financially and reputationally. Feedback loop created by index inclusion is both a blessing and a curse. While it can drive rapid growth, it also introduces systemic risks. If too much buying is concentrated in a few companies, any disruption like a negative ruling can trigger a rapid unwinding. This risk is at the heart of MSCI's concerns and is why the classification debate is so important. MSCI is one of the most influential index providers in the world. Its decisions affect trillions of dollars in assets and can move markets overnight. When MSCI updates its classification rules, investors pay close attention, knowing that these changes can have far-reaching consequences. The current debate over crypto holding companies is just the latest example of MSCI's market-shaping power. MSCI rules against crypto holding companies. The process of index removal will be swift and automatic. Passive funds will have no choice but to sell their holdings regardless of price. This mechanical selling can create sudden and severe price drops as there may not be enough buyers to absorb the supply. The risk of a liquidity crunch is real and could exacerbate market volatility. Pension funds are some of the largest passive investors in the world. Their mandates often require them to follow index rules strictly. If a company is removed from an index, pension funds must sell, regardless of their personal views on the stock. This can lead to large, coordinated selling events that amplify market moves and increase volatility. ETFs and other tracker funds operate under similar constraints. Their portfolios are designed to mirror specific indices, so any changes to index composition require immediate adjustments. This means that a negative ruling from MSCI would trigger a wave of selling across all such funds, further increasing downward pressure on affected stocks. Debate over classification is not just about a few companies, it's about the structure of the entire market. If passive funds are forced to sell en masse, it could destabilize prices and erode confidence in index investing. This risk is why the market has reacted so strongly to MSCI's update and why the outcome is so critical for the future of crypto. Since the October 10 update, investor sentiment has shifted dramatically. What was once optimism about continued growth has turned into caution and even fear. Many investors are now sitting on the sidelines, waiting for more clarity before making any big moves. This change in sentiment is a major reason why the market has struggled to recover. With so much uncertainty in the air, market volatility has increased. Price swings have become more frequent and more severe as traders react to every new development. This heightened volatility makes it even harder for the market to find its footing and for investors to feel confident about the future. For now, the market is in a holding pattern. Investors are waiting for the official ruling in January before making any major decisions. This period of uncertainty is likely to continue, with low trading volumes and limited price movement. Everyone is watching and waiting, knowing that the next big move will be determined by MSCI's decision. Current situation is the result of a unique set of circumstances. The rise of DATs, the power of passive funds, and the influence of index providers have all combined to create a fragile market structure. When MSCI questioned the classification of crypto holding companies, it exposed a vulnerability that few had considered. Now, the market is grappling with the consequences. This episode offers important lessons for investors. It shows how structural changes can have outsized effects on markets and why it's important to pay attention to index rules and classifications. Understanding these dynamics can help investors anticipate risks and position themselves more effectively in the future. The events of October 10 highlight the importance of timing in the markets. Smart money was able to react quickly to new information, positioning themselves ahead of the crowd. For individual investors, staying informed and being ready to act can make all the difference when structural changes occur. The future of the crypto market now hinges on the outcome of MSCI's ruling. If the decision is positive, the sector could see a rapid recovery and renewed growth. If it's negative, further declines and increased volatility are likely. Either way, the next few months will be crucial for investors and companies alike. Investors should prepare for both scenarios. This means managing risk, staying diversified, and keeping an eye on developments from MSCI. By being proactive and flexible, investors can navigate the uncertainty and position themselves for whatever comes next. The implications of MSCI's ruling go beyond just crypto holding companies. The decision could set a precedent for how other asset-heavy companies are classified and treated by index providers. This could have ripple effects across the entire market, influencing investment strategies and fund flows for years to come. Index providers like MSCI must balance the needs of investors, the integrity of their indices, and the risks of market feedback loops. Their decisions are based on complex criteria and can have far-reaching consequences. Understanding how these organizations operate can help investors anticipate future changes and adapt their strategies accordingly. Regulatory uncertainty is another factor weighing on the market. As governments and regulators grapple with how to classify and oversee crypto-related companies, investors face additional risks. The outcome of MSCI's ruling could influence future regulatory decisions and shape the landscape for years to come. Passive investing has revolutionized markets, making it easier and cheaper for investors to gain exposure to a wide range of assets. However, it also introduces new risks, such as mechanical buying and selling that can amplify market moves. The current situation with crypto holding companies is a prime example of both the benefits and the dangers of passive investing. Behind every market move are people making decisions, whether it's index committee members, fund managers, or individual investors. Understanding the motivations and incentives of these players can provide valuable insights into how markets react to structural changes. In the end, it's human behavior that drives markets, even in an age of automation. Market history is full of examples where structural changes led to major price moves. By studying these events, investors can better understand the risks and opportunities that come with index changes and classification debates. The October 10 crash is just the latest chapter in this ongoing story. In fast-moving markets, staying informed is more important than ever. Keeping up with news from index providers, regulators, and major market players can help investors anticipate changes and react quickly. Information is power, especially when structural shifts are in play. Best investors are those who can adapt their strategies to changing market conditions. Whether the MSCI ruling is positive or negative, being flexible and ready to pivot will be key to navigating the uncertainty. This means having a plan for both scenarios and being willing to adjust as new information emerges. Structural changes like the one triggered by MSCI's update can have far-reaching effects on markets. They can alter the behavior of investors, shift capital flows, and even change the trajectory of entire sectors. Recognizing these shifts early can give investors a significant edge. As we approach the January 15 ruling, keep an eye on market sentiment, trading volumes, and any new statements from MSCI or other index providers. These signals can provide clues about how the market is positioning itself and what to expect in the aftermath of the decision. The outcome of this debate will shape the future of crypto holding companies and could influence how other asset-heavy firms are treated. It's a reminder that market rules and classifications matter and that investors need to stay alert to changes that could impact their portfolios. Sum up, the October 10 crash was not a random event. It was triggered by a structural threat to the market's strongest buyers, as MSCI questioned the classification of crypto holding companies. The outcome of this debate will determine whether the market can recover or if further declines are ahead. Investors should stay informed, manage risk, and be ready to adapt as the situation evolves. The key takeaways from this episode are clear. Structural changes can move markets, index rules matter, and staying informed is essential. Whether the ruling is positive or negative, being prepared and flexible will help investors navigate the uncertainty and seize new opportunities as they arise. As we await the final ruling, remember that markets are shaped by both structural forces and human behavior. By understanding the interplay between these factors, investors can better navigate periods of uncertainty and position themselves for long-term success. The story of the October 10 crash is a powerful reminder of the importance of staying alert and adaptable in a rapidly changing world.